I am Lisa from Carter Realty Group. Carter Realty Group is on the west side of Joliet. This is our hometown. I was born and raised here. I actually was born and raised right in the next block on Desplain Street. So, so this is South End is my neighborhood. So I wanted to thank you guys for being here. But Carter Realty Group is a realty group that's been in existence for almost 12 years, 11 years. It is a Black-owned, veteran-owned, woman-owned agency. Thank you. So I'm very proud to be one of the members, one of the agents of that realty group. My background is actually in customer service and sales. So what happened is when COVID happened, my life changed a little bit, but guess what? I'm okay with that. Like, it was supposed to be that, right? I've always said to myself, please God, lead me into my purpose. So I know my purpose is customer service because I love doing it. No matter where I've been, I've had to reinvent myself. Don't get me wrong, because it's trying. But that is, I know that's where I'm supposed to be, in service, in customer service. So I'm going to take a moment and have the panel introduce themselves, and then we'll get into the thick of things, okay?
Well, good afternoon, everyone. My name is Dan Pagano. I'm with Wintrust Mortgage. I'm going to talk to you today about not only first-time home ownership, but also home ownership.
Hello, everyone. My name is Jerhan Cameron. I do the credit repair for Carter Realty. So if you're looking for a home and you're like, hey, I think I'm right there on the cusp, etc., I'm here to help you to say, let's see how we can move that so that you'll be able to purchase a home.
Good afternoon, everyone. My name is Randall Moffitt. I'm one of Carmen's top agents, and I'm just here if you guys got any questions or anything. Maybe I can clear some stuff up for you.
You see what he did there? You see what he did? Top agent. I see that. But he's not wrong. So we got a lot of great agents at the agency. So what we're going to talk about today, this series for today is going to talk about home buying, home ownership, selling, the market a little bit. We're going to touch just a little bit because there was a question about asset management groups. Dan actually is going to touch on that just a little bit. But anything that we don't cover in this session, all of us are available to you. That's what this is about. This is not just gathering information. This is about putting things into action. We are here to help you with that, okay? So if we don't answer all your questions in this session, make sure that you see one of us before you leave. So I'm gonna, Randall, can you help me out? Can you pass these books out? So these are our home books from Carter Realty. In the back of these home books, there are places where you can take notes. If you don't have a notebook, we back in school, y'all. Y'all didn't know that, did you? If you're not learning, you're not growing, right? And I think I got extra pens somewhere too out in the hallway if we need some as well. So I anticipated we may need some pens. So does anybody need a pen? Anybody? Can you grab the, oh, okay, thank you. Jerhan's gonna grab the pens for us. So let me get the book, make sure I stay on track. So the one thing that Carter Realty does, no matter whether you're buying or selling, because buying or selling is, let's get an understanding right now. It is not easy, okay? The process can be very cumbersome, frustrating. It can be long, it can be short, it can be intrusive. And what I mean by intrusive, there's a lot of gathering of personal information that we must do, not only as agents, but especially as a credit improvement agent, right? As well as the lender. The lender's gonna get a microscope. But so I just want you guys to understand that if you do, Matter of fact, who has bought a home before? Fantastic. How long ago? 13 years. Do you remember everything you went through in those 13 years? Exactly. Right? So that's why, did you use an agent when you purchased? Would you use an agent again? You don't know? Okay. That's honest. That's honest, because there's a lot out there as to our value and what we bring to the table, but I guarantee you I'm gonna solidify that in these next 2 hours, right? Okay. So the buying and selling process, who has sold a home? Who sold a home? Okay. How long ago? 6 months ago? And how did that experience go? Okay. Tell me why not the best? You got an offer and it wasn't what you wanted. Tell me what happened. It was good? Okay. So not the best, but that part was good. Okay, gotcha. What makes it not the best for you? Because none of it is easy, right? So what's not the best? When you said that, what came to mind? Yeah, so like I said, that's part of that intrusiveness I was talking about on the buy side, but it can be on the sell side too as well. So, but we're gonna concentrate in this next hour probably about the buying and preparation, right? So what is the first thing you should do when you are in the midst of thinking about buying? What is the first thing do you think you should be doing? Yes, ma'am. Say again? No, that's not the first, but that's within the process, right? We're talking about before we even get to the process. What's the first thing you should consider for yourselves?
I'm sorry, can you all talk loudly because they're streaming and we want to be able to hear the questions as well.
Say that one more time. I got it. Say it.
What can you afford?
Anybody? You think? So yeah, he's hitting the nail right on the head. That's that planning stage, right? So planning what you can afford, your expenses, get your numbers together, right? Because what's going to happen is if you don't have a plan or what that looks like, and we can counsel you to that, right? There are stages that you're not going to be able to either understand or get through without a plan. We need to know what it is you need from us so we can service you the right way. We need to know what that budget is, right? And with all due respect, we like to work within your budget at Carter Realty Group. We don't care if you get approved for $300,000, but if your wallet says you can only afford $200,000, let's have that conversation, okay? Because what's important is not just the buying, but the sustainability. What is happening is across the USA, African Americans, not minorities, hear what I'm saying. African Americans are losing a percentage of the market in droves. We are the lowest in terms of ownership. We have been surpassed by Hispanics, Asians, Middle Easterns, because some of the decisions we probably have made, and because we have to be careful in who we trust with our money. We have these two individuals here because we have gained a partnership. We've proven ourselves to them, and they've proven themselves to us. So whoever you go with, make sure you go with someone that has partners that are working for us, for you. Okay, keep that in mind. But please, why are we the lowest? I think a couple of things have happened. I think, one, we buy above our means. And I think also some of the past lending practices may have gotten us into mortgages that we could not handle. So that's part of the issues that we're having. It is noted. I didn't bring articles with me, but I'll be glad to pull some things up that shows that when it comes to practices in minorities on home ownership, there's been some bad practices in the past. Has that been regulated since? Yes, but we still have our own responsibility to ourselves not to buy at $300,000 if $200,000 is best for us. We do have accountability in that. And that's what I want to talk about today is our accountability, right? In that, and how do we get step by step, 1 foot at a time, 1 foot in front of the other, not getting too far in front of ourselves and preparing ourselves for the responsibility. Because remember, home ownership is a huge responsibility, not only to you, but to your neighborhood around you, because your value is based, their value is based on your value is based on their value. It goes the same way. We got to keep our values up, right? So we're going to talk about a little bit of that today. But I want to get, so planning is one of the first things. What else do we need to do? So in planning in our budget, right? What else within our budget do we need to do? Yes. She's not wrong, right? So you do need a real estate agent. We do recommend a lawyer because even me with the legal jargon, we will have a lawyer here next week too, by the way. But even some of the legal jargon and some of the things on the contract, I know the contract, but when it comes to that negotiation part, once we have a contract, then we leave that up to the attorneys, right? But what else do we need to do? How do we prepare ourselves for purchasing? We're planning, what else are we doing? There we go, right? So we're working on being qualified, right? Because a bank will not let you purchase unless you are qualified, right? So not only planning, buying with our means, qualification, what else must we do? Anybody else? Right there, money, right? What is happening in the industry, the prices keep going up, interest rates go back and forth. Interest rates, we'll talk about that for a little bit, but interest rates, they're gonna fluctuate. You can fluctuate with interest rates though, but you can't fluctuate with inflation when it comes to the cost of the house. Houses are going up. Interest rates go back and forth, so choose your battle, right? Okay. So we're gonna get a little bit more into the credit portion of this and what that looks like. And so for that, we have our expert Johan here. She's gonna walk us through that part, okay? Do you want to?
Hello, everyone. So my name is Johan Cameron again, and for those who already know me, I am Pastor Bearfield's sister, his favorite sister. But you guys know me, you know that I like to ramble, so I took notes so that I can stay on cue. I believe they have the PowerPoint, Sean, to put up. So I put a PowerPoint up just so that you can take notes, as she said, because when I'm going through numbers, etc. And my main thing is to simply say, okay, credit. One thing I think that they should do is teach it in high school. In high school, they should really just teach you, as I say, the tips and tricks. And so I can't do a deep dive unless I have your credit report in front of me, but I want to show you tips and tricks that I say, hey, if we would have known this coming out of high school, it would have helped to say, oh, okay. So one thing I'll tell people, they'll be like, oh, I have bad credit, I can't do this. Credit can be fixed. Remember that. So even if you meet a guy and his credit's not that great, you know, call me. I'll just help him out. But you gotta, it's not really just the credit. It can be the richest person, they have low credit. Why? Because they can afford whatever. They don't need the credit to get it. So when I'm talking to you, it's more like, hey, this is the steps on how to play the game. That's what I like to call it. Credit is a game. So I'm waiting to see if Sean's gonna put up the PowerPoint before I get started. And then I'll have questions, I'll answer questions afterwards too, so I won't be before you long. He said it's coming. But while it's coming, I'll just talk. So, main thing about credit is the FICO score. Yeah, there we go. So it's your FICO score, and most people are like, well, what is that? It's just simply it says Fair, Isaac and Company. That's what FICO stands for. But the main thing that I like to show people is that, hey, what do I do? How do I get started? When she said, what's the first step? you can get a copy of your credit report. So write this down. I don't have it on a PowerPoint, but there are three different places you can go. If you go to annualcreditreport.com, so write that down, annualcreditreport.com. With most places, you can always get each year a free copy of your credit report. So if you haven't gotten it, fine. Now with some places, they'll do it every 4 months for you. Otherwise, annualcreditreport.com, once a year, you can always get a copy of your credit report, okay? Second place you can go to identityiq.com. So I'm giving you guys 3 places. That's identityiq.com. And then the last one is Experian.com. Because a lot of people are like, hey, I want to go through one of the different places. Because you know with credit, you got Experian, you got Equifax, and then you got TransUnion, okay, with those 3. So a lot of people will do it through Experian.com. And that way, you can get a copy of your credit report. So today I'm going to talk about tips to improve your credit report. And if you jump on in there, I just want you guys to know the average credit score, go ahead to the next slide. The average credit score for a person is 675. Now, is that good or bad? This is why I put up the report card. So looking up at my, as I call it, my beautiful report card, you'll say, hey, 751 or higher is an A+. Can everybody see that? So the reason why I put the PowerPoint up is like, write this down, because the best way to describe it, I said, let's put it as a grade report. Hey, we got an A+ if we're 751 or above. You got around 750, well, I don't know what Sean's doing. Between 750 and 680 is kind of like an A+, instead of the plus, A+. A minus to B minus, 675 to 670, B plus to B minus, and so on and so forth. Now, I say this is me giving you a nice grade report in general, but like I said, I type notes to kind of break it down for you. A credit score of 720 or more means that you have excellent credit to most creditors, okay? 720 or more. Now that's 751, like I told you, and up, it's great. The range is 300 to 850. Write that down, because a lot of people don't know that. This is how you know. You meet someone, you're like, what's your credit score? They be like, I pay like a 919, I got great credit. Okay, they don't know. They just told you something. So at least you know where it ranges, okay? Second thing, a credit score between 680 and 717, it basically means you have good credit and you probably won't have too many loan or credit people that won't, disqualify you, but it may not qualify for the best available rates. So that's when it comes to the different numbers, where it's like, hey, if I have this, you know how, I'll say it, my mom had great credit. We would go into the car dealership and they'd be like, you can have anything you want. I'm like, no, she can't. And like she said, just because your budget says you can afford the $300,000 house, doesn't mean that's the house that you should go for. You know what I'm saying? Because your budget's saying something different than what you qualify for. So like I said, the A++, it's a little different level. A credit score between 620 and 679, just writing that down, between 620 and 679. Now that will prompt most lenders to take a closer look at you, because what they're looking at is they're basically saying, hey, how's their financial health? It's kind of teeter-tottering, but it's not bad, but that's what they're looking at. Remember, I said the average person is 675, but you may still have a pretty good chance to qualify the credit that you want. Now, when I look at scores that are between 570 and 619, they're considered a higher risk, okay? And you will just immediately, they'll take you out of the running, that interest rate for that car loan is going to be very, very high. And then any credit score below 570, seriously, I always say that's where you're going to probably have to get some credit and some loans because you're not going to really thrive on that. So any questions between that, just write them down, let me know. But I did that as a credit score to kind of say, hey, let's look at a report card and see how if they broke this down for us in high school, I promise you it'll help us out so much. So knowing that, we'll then go to my next portion of it. Okay, next slide. So now that we know where it ranges, okay, 300 to 850, now I like to say, how do they get to the credit score? A lot of people tell you got to do this, you got to do that. I'm trying to break it down in percentages. So at the top of your page, if you just go ahead and type 35%, if you're doing notes in your thing, 35%, type payment history. 35% of this score is payment history. What does that mean? On-time payments, okay? So if you're making on-time payments, then it's like, yep, that's gonna help. That's 35, that's the biggest chunk of it if you see. I'm gonna give you an example of what all shows up under your payment history. We wanna make sure that you're paying on time, So that's a great thing. You can buy those, you can get on the links like creditkarma.com. And if you have Credit Karma, the score may not always be right. That's not who I gave you to get your credit score. But they do have a nice link for you where at the bottom, it'll tell you how you've been paying. So let's say you had this credit card, I have a check mark, you're paying on time, right? So anything as far as like collections, tax loans, late payments, charge-offs, all of that, that's all coming under that payment history. That's the 35%, okay? Next, we're coming down as the 30%. That equates to your amount owed, okay? That's 30% of your score. So that's basically how much you owe versus how much you could owe. And the way I have it up there, I put it as debt to income ratio because, excuse me, it kind of shows people what I mean by that. I need a mint. Or I always say you can say debt to credit ratio. That's another way to kind of say it. Excuse me. So basically what I'm saying is, this is the best way to describe that. All your money debt divided by your yearly income gross. That's how you get the debt to rate income, right? To look at it credit-wise, I always say, look at how much you owe on that credit card. How much the balance of that credit card is. It's $5,000, right? How much of it do you think that you're supposed to be spending on it where it won't affect that ratio as much? If you don't know, remember when I gave you these numbers? It's the same number, 30%. So when you have a credit card, they gave you a $5,000 limit, right? The best way to keep your credit score at good standing and your points, because they want you to have the credit, is go ahead and take 30% of that. So that's $1,500. That's as much as they want you to go over on that. Oh, thank you. To go over on that card. Oh, my knees. Thank you. I appreciate that. Okay, so everybody got that part? That's key. Because I always say if you want a tip or a trick, that's a tip or trick for you. Okay? Now, one thing that you can also do, write this down as a trick, you can increase your limit with your credit card. So let's say you've had your credit card for 3 years, 4 years, call the creditor. Ask them, can I increase my limit? Especially if you're in good standing with payment. That's another trick because it looks as if you have. You see, now I have, instead of $5,000, I have $6,000, I have $7,000. And now that number changes for that 30% of what you can put on there monthly. So it's nothing wrong with having the credit cards, but if you're just taking that credit card as $5,000 limit and you're making that $5,000 limit each month, you're trying to pay that down, that's still hurting your credit, okay? You guys nod at me, let me know if I'm making sense to you, because if not, I'll go deeper into it. Well, another thing that you can do, another tip is reset the payment due date to just prior to the credit reporting. So you can call your creditor and say, when do you report to the credit bureau? If they say that they report on the 15th of each month, make it where your due date is prior to, because if you're paying on to it right before then, it looks like, oh, look at that, great standing. Just going. It's another trick that you can do and they will tell you, okay? Also, different companies that you may have. Capital One, I want you guys to know, Capital One doesn't report your credit limits, and they will also raise your score if you're, they'll also raise your credit percentage if your credit score goes down. So watch that with Capital One. Those of you who have an Amex, I always say they don't report credit limits. That's another trick. So if you have an Amex card, your credit limit is $50,000. You're like, oh, that's so great. Not really for your credit report. So when you're looking at different cards, if you're some of my people who don't have credit, we'll talk about that. Amex, just remember that. And also too, I know that he's gonna probably talk about it too, but that home equity line of credit that some of you guys may have, by law, if it's more than $75K, that's gonna be reported under the installment debt, okay? So if you're pulling out that home equity line of credit, I just wanna throw those tips in there too. The next one is 15% of that. Oh, I could just write down your question, but go ahead. Oh, I'll break those down. I'm glad you asked that. She said, what do you mean by installment debt? I'll explain like the different types of like revolving installments. I'll explain that in just a sec. Don't worry. 15%, as I said, is your length of credit. Okay? This is where a lot of people, one of my biggest tips that they love, but they're not really listening to how I said to do it. So the average age of your open accounts, the longer the better. okay? So if you are paying off a credit card, you had that credit card for 10 years, and you're like, okay, Jahan said pay it off. I done got to pay it down. I'm closing that account, so I don't use that card anymore. No, don't do that. People will tell you that. Do not do that. Why? Because you have 10 years on that card. I want you to go ahead and keep that card because that 10-year helps. So remember, 15% of it is the length of credit. Another trick that people love with this is they call it the piggyback. I'll touch on it again at the end when I say write down the tips. When they say piggyback, you'll hear someone say, hey, grandma has had her credit card for 50 years. Grandma's credit limit is $50,000, okay? Grandma pays her credit card on time. What do you do when I say piggyback? That's one of the tricks that most people will tell you to do to boost your credit quickly. Ask grandma, Grandma, can I get on your credit card? I want to get on there as a user on the card, meaning that I'm an authorized user on the card. Grandma, she's going to be like, no, honey, I don't trust you. I don't trust how you going, I see how you be spending money. Or grandma's like, no, baby, I don't trust you. Say, Grandma, this is what I want you to do. I want you to put me as on your card, but I'm not going to use it. When it comes, cut it up, Grandma. Cut it up. I'm not going to be able to use it. I don't have access. I can't call the credit company and say, hey, do this or that. Cut it up. It's going to come to your address. I don't want it. I just want to be on your particular card. Why? Because again, length of credit is 15% boost. You know, so I'm using that as an example. Now there's tricks to this. Now I'm giving you guys different tricks, but when we ever sit down, if you're really trying to change your credit, also remember, if grandma just got that card 2 days ago, or if my grandma just got that card 3 years ago, that could hurt you if one of your long-standing cards is 15 years. You know what I'm saying? So it's more into it than it is, because most people just go with the piggyback. Like, oh, my friend has great credit, and she's had her credit card, so I'm going to go ahead and get on there so I can boost my credit. And then you'll be like, oh my gosh, my credit went down. Why? Because grandma only had it for 2 years, and your longest-standing is 10 years. And so it goes into a whole percentage on how long you've had credit, and that just brought it down. Okay? So that's another trick. You can go ahead and go to the next slide. I'll go into my final portion of tips. That way people can ask questions. So if you can see that, I kind of just went over just everything that I kind of said before, but you want to, I can't read that up there, so I'll read it down here. You want to make sure that you make your payments on time, okay? Pay down your debt over time. When I say pay down your debt, for example, you got your income tax. When you get your income tax, instead of, put some in your savings, but go ahead and start paying down that debt, okay? That's one tip that I always say. A lot of people aren't doing that. Piggyback, I just gave you the piggyback tip. Another one is use secured credit cards. And some people say, well, what do you mean by secured? There are ways that you can go ahead and get a secured credit card. You're going to go ahead and give that particular lender $350. That's now your credit. So they're going to put it on a card, and you're basically spending that credit card as if it's a regular credit card, but it's really your $350. But that's a credit card, so it's on there. So you want to go ahead. That's a great tip that I always say. Another thing that I have up there is, pay under 2 years. So anything that's under those 2 years, that's on there. So like say you got the debt and it's, say it's 2 years old, you want to make sure those are paid, okay? Especially those newer ones. You want to make sure that those are paid. Be patient. So especially when it comes to buying a home, a lot of times you're like, hey, my credit score is here and I'm trying to get it here, Jahan. We may have a longer climb to go because there are different type of tricks that we have to do or different payments we have to do, and over time, credit has to see that you're going to make this consistent. Oh, now you're paying on it, but how are you consistently paying on it? So that's another one. And now the last thing that I want to say too is, like she said, what is the types of debt? Because, I didn't do the other two, I'm sorry. You guys didn't even say nothing. The 10% of debt, if you go back up one, I'm sorry. Go back up a slide for me, Sean, and I'll be quickly out of your way. I didn't do the last two, the 10% type of debt. When you had a great question. You said, what are the types of debt? And then inquiries, I want to make sure I talk about that. So there's revolving. When there's revolving credit, it's just pretty much like your credit card, the home loan, anything like that. That's like a revolving. So it's like a little revolving door. Installment is more like your auto loan, or let's say you get a state loan or any kind of loan that you have. Also, with your home line equity or credit, anything that's above $75K, that's what we mean. That's going to fall under installment. So you know what I mean now? It's a difference of the different types of debt. So they like to see different types of debt on your actual credit. So you'll talk to someone that's going to give you financial fitness and say, hey, no credit cards. But if you're trying to get something that requires credit, you're going to have credit cards. Those are two different conversations. And they like to see a variety. So they'll see revolving, like the credit cards, things like that. I would love to see a home loan. I would love to see a car loan. Someone will say to me, Jahan, I just got this big check. Should I pay off my car? Mm-mm. Put that money in an account. Go ahead and have the car dealer, where they're each month still taking it automatically. So it's just like paying it off, but guess what? I need that. I need that credit there to show that I have a variety of debt. And then the last one is kind of open. So a lot of times you can have like your phone bill, cable bill, and different things, utilities. That's the open portion. Okay, so I just want to say that. But that's only 10% of the whole credit score. And then the last one is inquiries. You know how you go somewhere and they're like, hey, I'm at TJ Maxx, would you like to go ahead and open up this card? We can just go ahead and take 25% off. And you know good and well, your credit not that good and they're not gonna approve you. And you go ahead and let that cashier run that card. Do not. I cringe every time they ask me. No. You know, no. Why? Because that's a hard inquiry. When you have a hard inquiry, that counts against your score. It can range from 5 points to 30 points. That's coming off your score. We have a goal here. We're trying to buy a house. I don't need you to go into TJ Maxx and get another card. Now, if we're building credit, that's a different conversation. But that's hard inquiry. Now, soft inquiry. You can ask the person, and they'll say to you, hey, this is a soft inquiry. Or you can ask them, hey, is that hard or soft? The difference is a soft inquiry on your credit, that's basically, hey, that's not going to count. It's not going to show. So just give you an example. Like a hard would be like a car loan, a home loan. If you're a renter, like they're pulling your credit, see if I can go ahead and rent this home to you. That's a hard one. Credit card, any of that. And it's usually within that 30 days or so. So let's say you do a car loan, you go over to this dealer, they run your credit, you go to another dealer, they run your credit, and you're like, oh no, Jahan, it's too hard. It's not. Within 30 days, if you're looking for a vehicle, then guess what? That's all still gonna be one. Same with the house. So, you know, you talk to the Carter Realty and the finance person is running these different banks, don't worry, it's still gonna be the one within that 30 to 45 days, okay? So that still counts as one, don't panic. That doesn't work with credit cards. You decide you wanna get a credit card here, get a credit card here, it's a hard inquiry. It's a little different, okay? Soft, examples of soft, like for instance, I work in insurance. They run your credit, yes they do, when they're about to give you car insurance, but it's a soft hit. That's not gonna hit it, okay? Background checks, you're applying for a job, they do a background check, yep, they ran it, okay? But it's soft, okay? Utilities, different things like that. A loan application could also be soft, okay? So I wanted to say that. You had a question about that. It can, it was a great question. She said, if I pay my vehicle off, can my credit go down? Yes, it can. Okay, it's kind of a twofold. It depends what else. So like, I would have to really look at your credit report, and let's just say you were at Carter Realty and you said, oh, Jahan, I'm right here. To get the home, I need 720. Okay, I'm just saying with Carter, it's really, what is it, 690? What do you guys have it at? To get a loan? 580? Okay, so say it's 580. You're right here at 570. Well, no, you're right here at 580. You're right here at 580. And then you pay off the car. And we're like, wait, you paid off the car because you're like, oh, I'm about to buy a house, accept and pay it off. And then it dropped. Now you're at the 570. It will eventually go back up, but just so you know, yeah. So I'm not saying don't pay your car note. I'm not saying it's a great gift when at the end you paid it off. I'm saying when people hit that big money, they're like, I'm just gonna pay it off. But do you have a variety where it's still gonna sustain your score? What was your other question? It depends on everything else that's on your, so going back to the payment history and everything that's on your credit, you can usually see a change, sometimes within 30 days, but sometimes it may take like up to a year. But it depends on what other variety you have on your actual credit report. So for example, if that's the only thing I have, I just have my car and maybe 2 credit cards. You know, where's my variety? See what I'm saying? So that's where it hurts. It's not gonna hurt it too drastically depending on how everything else is going, but just know your score is going down. Because we need something. We like it.
Yes, can we use the mic? We can't hear you guys on the stream.
Oh,
When you guys are asking questions, can we use the mic?
okay. And I'll step down because I'll still answer questions, but after me is coming up is Dan. And Dan's gonna go into mortgage and money and basically how to leverage your existing home, if you have one. If you're like, hey, I don't need to buy a home, Gerard, but I want to go ahead and get me an investment property. Yep, that's where Dan's going to come in. And then if you
Actually, I've got a question
a
for you,
question for
and a compliment. I've never heard that tip about adjusting your payment date, and I thought that was fantastic.
Oh, thank you.
Yeah. So my question is, and this is one I see all the time, so I want it to be answered for the group. What is the difference between paying a collection or getting a letter for deletion?
Oh, that's a great question. And that can go into so many different ways. I'm glad you said that. A lot of people think that, hey, I went ahead and I have a collection and I didn't pay it. You're asking if they didn't pay it?
The difference between paying it or getting a letter for deletion.
Yes, the difference between paying and letter of deletion. You paid it, guess what? It's still there on your credit. It's still there. You paid them. You have to make sure that you get a letter of deletion. That's what he wants me to say to you. That's basically what you want. A lot of people will say, hey, I've been working with whomever, and I'm going to go ahead and make sure I pay off all my debt and everything else, and you just go ahead and pay that collection company. Guess what? When you get your report, it's still sitting down there. It just says 0 now, but it's still sitting down there. That's still negative. They're still looking at that. You tell them, no, I want it off. Take it off. And you want them to send you a letter. It's a great question.
Any other questions? Don't let her go without asking.
So we're getting a letter from,
You're getting a letter from the collection agency. So you went ahead and got a collections that said, hey, you didn't pay your credit card, and they went ahead and sold that collection over to Johnny Jones Collection Agency. And then now you're getting ready to start the home buying process, and you're like, hey, I need to go ahead and clean out these collections. I just didn't want to pay that $75 from whatever, okay? And so you're going to go ahead and call the collections. You just went ahead and just paid it, you know? And now they're like, oh, thank you, you got it and everything else. It's still there. You didn't ask them for a letter of deletion, so you need to contact them so that they can have and ask for a letter of deletion to show that that's taken off. If it's a charge-off, it's still going to show. It shows charge-off on the actual report. Good question. Ask them to delete it. Okay, I'm going to pass it on over.
I have a question.
Okay, go ahead.
So that subject kind of brings up a few things when it comes to credit, right? Because bad credit is bad credit,
Yes.
right?
That's why I gave you the great report.
Yep. So bad credit is bad credit. How can you, what's the counter to having bad credit? What is the solution to get your credit score up if you have bad credit? Is it the payoff?
Well, the
Or-
solution is a lot of, as I say, tips and tricks you can do. The main thing, as you said, the top one was what? Y'all tell me, what was the top one? Payment history. Somebody said it, I think. Okay. Yes. So the top thing is that creditors, they're not slow. So just because you decided to go in and say, hey, or you ask grandma to help pay off different debts that you have because you're trying to buy a home, and you're like, Johan, my credit score isn't moving. We see your history. You just went ahead and paid off a couple credit cards, which is good, but I don't see your history. I don't trust you yet. I don't see that you're going to pay consistently. You know what I'm saying? So you want to make sure that you're paying consistently. If you can afford to get on automatic payments on different things that you have, do that. Because that way you're not, oops, I missed that payment. Another tip too, let's say you paid consistently, and then that 1 month something came up, etc., and you missed it, and guess what? They reported it to the creditor, and now you have that X. Instead of a check mark to say you paid on time, call your credit card company and say, hey, I've been an outstanding payer thus far. Can you have that changed? They will change it. Well, they can, is what I'll say. So ask, yes. She said, do you have to have credit in order to get credit? Yes. So what she means by that, if you're a person who's like, nope, I don't have any credit cards, Jahan, I don't have a home loan, I don't have a car note, I don't have anything to show that I'm paying someone and I can pay them back, I'm not gonna loan you a house because now I don't know you. You don't have any record or for me to say, this person can take this amount of money and pay it back on time. I don't know your history. You can show me that your bank account is here, but I don't know how you are as far as spending and being able to pay me back. Does that make sense? So that's why. They need to show some kind of history to say, oh, she does a great job of paying back her debt, he or she. So that's a great question. And that's a lot of people that are like, I have bad credit, or my credit's not that great because I don't have anything. Yes. Now, you'll meet people that are very wealthy, that have very bad credit, But the difference is when they come into that car loan place, I can go ahead and pay this car in cash. They don't need to use the bank to get the loan, etc. So that's where it's a difference. So that's why I say I'm not here to teach you money management. I'm teaching you how to play the credit game. And that's all that I want to do to help you get your home. Oh, sorry, last question, then I'll pass it on because I think my 15 minutes are way up. Yes. Yes, did you guys hear? What she said is, hey, if you don't have any credit, goes back to when I said the different types of loans that you can have when it goes into it, but that's just a small percentage. You can always have your cable bill and utility bills through Experian, making sure that it's showing on your credit. But you'll need more than that. But yes, that is a good tip. Thank you.
I'd like to add something as well. So there are a few local banks that have some programs that for people just establishing their credit where they will loan you $1,000, not actually give you the money. They'll open an account for you, put the $1,000 in, and you make 12 months worth of payments. It's like $85. And at the end of the 12 months, that $1,000 is yours. But while you're making your on-time payments, they report to all 3 credit agencies that you are making timely payments at the right amount. So that'll also help you boost your credit as well, or build it, I'm sorry. For those who can't go out and just get a secured card or a regular card, that's a perfect way to start. Like I said, at the end of it, you got $1,000, and during the whole year, you've been reporting 12 months on-time payments to all 3 credit agencies, and that'll establish some credit for you.
And there's tons of tips and tricks. I don't have the time to go over all of them, but that's what we're here for. So looking at your credit report, like I said, very first thing, get your credit report. See what's on there. See what your number is. And also, even things you have to look at. There's 3 different credit bureaus. TransUnion may have something on here that you're like, that's not mine, what is that? And then Experian does not. We need to hurry up and get that off. What is this? Okay? But you also got to be careful. If there's something that's on Experian and it's over on TransUnion, you know it's yours. I don't want Experian to find out. So let me hurry up and get this cleared on up. You know what I mean? So it's not, okay, well, let me call Experian and let them know, hey, I got a debt over here too that I don't see reporting on your side. Because also it depends on whatever you're getting a loan. Some don't look at Equifax at all. They just look at TransUnion. So, go ahead.
I was going to ask you, why do the credit companies, when you did your credit report Experian, TransUnion, Equifax, why did you do 3? You did have 3 different credit scores.
Yes, that's what I'm saying. You have 3 different. You have to look at the score, and you have to look at your actual report and see what's the difference. Because I guarantee it's something different on one versus the other. So yeah, that's a great question though.
Just to piggyback on that question though a little bit, what happens, and Johan could probably tell you this, is depending on also where you live, certain business entities pull based on regional reporting too. So if TransUnion is a Midwest reporting group and there's a company in the Midwest, they may elect to pull from TransUnion because they are known to have, I guess, viable or best information in that region. So if Experian pulls from the East Coast, then most businesses will probably, so each business does not use the same bureau necessarily to pull your information. That's why you see different reporting that can affect your credit report. But the bottom line is, there is, and Jahan can talk to this, and even Dan, but generally your FICO score, very important, Jahan could probably talk to this better, but your FICO score is the most consistent one that lenders would probably use in order to determine your viability in order to get a loan. But Jahan can speak to that a half a second as far as, did I say that good?
You said it great.
Okay.
You said it great.
I
And
told
that's
you,
why I said,
I'm
when
a
you're looking
realtor.
at it, get a copy of your credit report. There's nothing else that you have, because there's so many tips and tricks we can say. It's things with addresses you can do. You got all these old addresses that's connected to this or that, and that's pulling, and different things are coming to that. It's all kind of tips and tricks that I can sit up here and do. The reason why I had you write down the ones that are up there, those are the main ones. That piggyback works, but also ask me about it before you do it, because like I said, I had someone do it, and they're like, it went down, but the person just got the credit card 3 years ago. That's why, so things like that, you just want to go ahead and make sure that you go into it.
Thank you, Jahan, please, thank you. So just a couple of things before we move on to the next presenter. We are recording this, so that's why I was trying to run to give the microphone at the end. If you do have a question, if you could please stand at the middle microphone so that we can capture your question. The reason why is we want to make sure that the church can share this information with other groups and just capture the information, because this is important information. So the other thing is, so now we've gotten the planning stages, right? So we're planning. We know monies is important. Money man right here. But we know credit is important, because guess what the money man wants? Your credit. Yeah, he's gonna pull your credit score, right? He's gonna know if you're, want to see if you're viable, if you're a good candidate. So our next section is gonna be about planning and money. So the one thing I want to say about money too, please don't. The myth is, I think sometimes, is that there are loans out there that can help you purchase, but those loans need qualifications. First-time home buyer program, things of that nature. That does not mean you do not need, like this lady said, money in the bank. That is not what that means. We gotta stop thinking like that, right? Money in the bank. The other thing that I want to say about credit and savings and stuff, if you are saving money, this is all due respect, right? If you are saving money and you have savings in the bank and your credit is poor, those two don't even go together. Does not go together. If you have savings, that should be boosting your credit score so that you're viable for money, right? It just doesn't go together. So you have to have a sequence of things as well. So keep that in mind. And as a realtor will tell you in their consultation, there are certain monies you need up front too. So you gotta have something in the bank for me to even get you into houses to see. There's certain things you have to do. Once I got a contract, there's about 4 things before you even get to the closing table and get to the money, right? Even the grant money. There are about 4 things you have to pay for out of pocket before you even sign on the dotted line for the loan. So you have to have monies in the bank. What that looks like, consultation. Let us know how we can help, how we can get you there, and what we can do to help you. So now I'm going to introduce Dan. Don't forget, if you have a question, go up to the mic. Dan Pagano. He's with Wintrust Mortgage. He's one of our partner lenders, and he's going to talk to you about the lending process and a couple other things. Dan?
Thank you, Lisa. So, unlike Jerhan, I'm not related to the pastor, so, but like Jerhan, I do tend to babble a lot, so I'm going to try to rein it in. I also have an agenda. Mine's pretty brief. I learned this phrase called WAIT. It stands for Why Am I Talking? And I learned that when you're speaking, you should probably have a purpose. So my agenda is pretty simple. I've got why Wintrust, why Dan, and I've got what's in it for me. I feel like everybody who's listening has a what's in it for me filter, and I want to scratch that today. I want to make sure we get that satisfied. And then I've got Q&A, so that's my agenda. So, fact check me. Wintrust. So before we talk about Wintrust Mortgage, which is the mortgage company I work for, I make that delineation because I think it's important. I think it's important that I work at a mortgage company, not a bank. So most of the big box banks, and Wintrust is pretty big, by the way, we have 200 branches. But most of the big box banks, mortgage is a profit center for the bank. And it's also what they call, in my world, a sticky product. Sticky product, code for, you keep mortgages a long time, average 4 to 7 years. So they being the bank, have the ability to solicit you for anything and everything they peddle if you do a mortgage with them. So at Wintrust Mortgage, we're a mortgage company owned by a company called Wintrust Financial Services. WFS is publicly traded. You can buy the stock tomorrow, Monday morning. WFS, Wintrust Financial Services, they're also different, which is why I worked for them for the last decade. So what makes them different is they like, well, I'll do a little backstory. In 1978, in Beverly, Illinois, over cigars and more drinks than they care to admit, 4 bankers working at some of those big boxes we talked about said we can do this better. We're watching all of our community, and I emphasize the word community, we're watching all of our community banks get gobbled up by the big guys. We, like the banks our grandmothers used to walk to. So we want them to know your name if you're gonna drop your money off with us. So we think we can do it better. So they started Wintrust, Chicago's bank. So when they buy a company, they do it a little bit different than those big guys too. Okay, here's what they do. The big guys, what they're gonna do is they're gonna find a dented and bruised asset, a group of banks, that's in trouble. They're gonna explain to their shareholders how quickly they're gonna make those accretive or profitable. They're going to explain how quickly they will integrate their processes into that new bank that they've purchased. And then they're gonna rinse and repeat until they get so big that the SEC doesn't let them do it anymore. There's some guys like that, Chase Bank of America. So we don't do that. What we do is kind of the opposite. We buy assets that are revered. That same bank that we were talking about where grandma used to walk up the block to get there, where they do know your name. And we buy those, and then we seek them out. They're community banks. We do what we call reverse integration. We don't want to make them us. We want to make them, we want to imbibe what attracted us to that bank in the first place. So we'll fold that into our regular daily by making sure that we have the ability to retain those clients that have stayed with that bank and they're happy, but also to make our other clients happy by rinsing and repeating what they've done. So that's Wintrust Financial Services. And you'll even notice when we're done with a bank, after we're completely finished with the purchase, we won't even change their name. We'll just moniker it a Wintrust Community Bank, right? Joliet Bank and Trust, a Wintrust Community Bank. There's a couple hundred of them around. They're not just in Illinois either. They're in Minnesota, Wisconsin. We just bought 200 branches in Wisconsin, so we're getting a little bigger too, but we're not doing it any different than I described. So in Wintrust Financial Services, my parent company, remember, I don't work for them. They can't fire me today. If I say the wrong thing, they can't fire me. Wintrust Mortgage can. I work for a company they own. So when they wanted to do mortgages about 20 years ago, rather than make it a division of their bank where they can peddle all of their products to the consumers, they said, we're gonna buy a mortgage company that's up and running currently, respected and revered. And you probably don't remember it, but I can tell you it was Professional Mortgage Partners, PMP, and they bought that company about 25 years ago. In fact, just like the community banks, they just monikered it Wintrust Mortgage about 15 years ago. So it's a mortgage company. Why else do I tell you it's a mortgage company? Well, I tell you it's a mortgage company because I am a federally chartered banker. So what that means is I can originate loans in all 51 states. I say 51, it's only a matter until DC becomes a state. All 51 states I can do that, I'm licensed to do it. I can peddle Fannie Mae, Freddie Mac, Ginnie, VA products right off the shelf. That's not different than anybody, right? So I'm also a broker. That's the difference. So I can broker unique niche loans in situations where maybe the credit isn't perfect, situations where maybe you don't have as much money as Lisa wants you to have. I can find a home for those. And that's a hybrid. There's no other company in Chicagoland that does that. Banker, broker, so that's me. But like a Ginsu knife commercial, wait, there's more. I can also portfolio loans. And loans that are harbored on my portfolio, guess what? They don't meet the guidelines of Fannie Mae, Freddie Mac, or any of those big investment groups. That's okay. We can still house that right on the Wintrust portfolio. So the last thing that I want to talk about in regards to this is bond and grant loans, which is a lot of the literature I passed out. So bond and grant loans. Wintrust, I like double entendre. It's never appropriate at work though. So I have to switch to dad jokes. So I say Wintrust Mortgage is the biggest bond and grant lender in the universe. And the reason is nobody does more than us in the state of Illinois. So I just grouped up the universe there. The Illinois Development of Housing Authority, IDA, there's 80 approved IDA lenders. What IDA does is they get money from what's called the Hardest Hit Fund. So we got to go all the way back to the first financial recession. So we're talking, 7, 8, and the states that were hit the hardest from that setback get monies from what's called the Hardest Hit Fund. As you might imagine, Illinois is one, California is another. So what we do with that money and how we pay it back is how it's allocated. Basically, whether we have to pay it back or if there's interest applicable to it is dictated by how we allocate it. What we like to do is promote home ownership. So we do it by way of the Illinois Development Housing Authority grants. There can be as little as 4% of your purchase price, which is the one we gravitate to, but they can be as much as 10% as well. We gravitate to the lower ones because they're forgivable. Forgivable, you don't have to pay them back over time. So there's only 80 approved IDA lenders in Illinois. Of the 80, if you were to call all 80 of them, they would have the identical rates and the identical terms. The only thing different would be a loan origination fee, which were the lowest of what is allowed. So you're going to get the same, you're just not going to be working with number one. That's IDA. That's one grant. We have 27 prevalent grants. So I want to talk to you about one I'm really excited about. I'm one of 14 lenders in the country piloting this with Fannie Mae. If you were to Google it, if you were to Google Home Ready, you'd get pages and pages and pages of information. And here's what you'd find out. You'd find out Home Ready is a loan for people who maybe have a lower down payment, are maybe first-time home buyers, but they can be repeat home buyers. They're going to have a reduced mortgage insurance premium, and the rate will not have, and I'll teach you guys a term, this is worth writing down, LLPA, Loan Level Pricing Adjustments. Jerhan was talking about 720 FICO scores and how that's considered excellent. You know what? Before last year, anything above 720, if I said it once, I've said it 1,000 times, it's part of my shtick. Anything above 720 is bragging rights at a cocktail party. That's all it is, until last year. Last year, Fannie Mae and Freddie Mac added a bunch of LLPAs, loan level pricing adjustments, that impact your FICO at 730, 740, 750, 760, 770, and 780. So how do you get the best rate? Well, there's two ways. One, you can have a 780 FICO score. I don't have a 780 FICO score. Two is you can get a Home Ready loan. And all those loan level pricing adjustments are removed. So if you were to Google Home Ready, that's what you'd learn. And there'd be pages on it. If you were to Google Home Ready first, I did it, you won't see anything. Put that in quotes, you're not gonna find anything on that. Because we're one of 14 lenders with Home Ready First. Here's what Home Ready First is. I'm gonna hand you, here's a great delineator about this. It depends on where you're moving from. Most of the grants depend on things like income, FICO score. You can't buy a home over a certain dollar amount, and other restrictions as well. With the Home Ready First, it's how you qualify for it is where you're leaving, what home you're leaving, whether you rent it, own it. So an example would be, just to have an awareness, put the address of this church into my search tool, and this church, any homes around here would qualify. I would say about 30% of the homes I put addresses in do qualify for this product. There's no income restriction. If you're here and you're making $100,000 a second, don't think I make too much money, I don't qualify for this. There's no income restrictions. You can buy a house as expensive as you want. It's gonna cap out at $766,550 for the loan amount, because that's the conforming loan amount. But here's what's gonna happen. If you qualify for this, because let's say you live in a house that the search engine says you qualify, then at that point, I'm gonna hand you no less than $5,750 at the closing table. Real good chance you're gonna get $6,500. It's gonna be one or the other. Also, if you need an appraisal, and more often than not you will, we're gonna hand you $500 toward the appraisal. So probably, show of hands is fine, you can shout it out to you. Does everybody know the minimum amount you need on a conforming loan? The minimum you need to purchase a home with a conforming loan. Okay, so does anybody think it's 20%? Okay. 15, 10? I'm not seeing any hands, so I'll cut to the quick. It's 3. It's 3%. You know what you need for an FHA loan? And by the way, FHA loan isn't our first go-to. A lot of brokers will make it their first go-to. It's super profitable for them, but it's not our first go-to. We want to go to an FHA loan if we have to. FHA loan, 3.5% down, okay? Conventional, 3%. So we were talking about $300,000 and $200,000 houses. Let's say Lisa says, no, you can't do this. The bank says you can do 300, but we know your budget says 200. So what's the minimum down payment on a $200,000 house? The same $6,000 I'm gonna hand you. So now you didn't even save your down payment. Now you need the money, like Lisa said, for those 4 things that you're gonna need to do when you sign a contract. One's pay for an appraisal. Here's the good news. If you qualify for Home Ready First, I'm gonna give you that money back. But you still have to pay for it up front. You're gonna need to hire a lawyer. So you're gonna need a couple $1,000s off to the side. but you don't have to worry about the down payment. I got you. So that's one we're really excited about because, again, there's only 14 different lenders. Who's applied for a mortgage in the last couple of years? Anybody? Okay, cool. So you know when the mortgage loan officer hits the button to run your credit, about 4 or 5 people start calling you, right? They want to peddle their wares. Those are called trigger leads. Yeah, Experian sells them. Experian thinks you guys are worth 80 cents a piece. I don't. They do. They sell all your information. So you have to be sort of in the know on how to avoid that. By the way, it was probably 6 people when you did it. Now, because of the current environment and how tough things are and stressful things are, 20 people buy that lead. And they chirp on your phone, calls, texts, emails the entire time. After you've already closed already. And they're still calling you, wanting your business. So those are the types of things that you'll experience when you do apply for a mortgage. One of the ways that I'll hedge from that happening is when I'm doing your loan amount, I'll put it at $1. You're putting 50 cents down, so you're putting half down. I'll remove your phone numbers. I'll remove your email address just so that when I push that button, and I'll also send you a government opt-out where you can opt out of unsolicited calls, texts, and emails. And then when I push that button, even though some of that information is still available, I'm going to make a lot of that noise go away. But with that, we're looking at 3% down for a conventional loan. So those aren't the only grants that we have. I put a few more in the brochure that I passed out. Like I said, I couldn't put them all in there. We have 27. We have others. We have 27 prevalent ones. I like to add grants too. I learned about a grant through Carter Real Estate, $25,000 grant, Will County. They only have it a little bit, they have a few grants a year. They open it up a couple of times a year. You have to make a certain income to qualify, but you know what, we've got that grant now, so we can help somebody when it comes up. So if you hear about something and we haven't talked about it today, I can always add that too. So that's a little bit about Wintrust Financial Services, a little bit about Wintrust Mortgage, a little bit about myself. How do I bore you? I wish I had an event like this when I was 19, 18 years old. I bought my first place when I was 21. Nobody told me that I didn't have to spend the night on my brother's couch for 3 years and pay him I never rented in my life, unless you count the $300 a month I gave my brother. His wife's a good cook, though. I didn't have to pay for food. But I could have spent 3 less years on his couch because I could have bought earlier if I had been at a meeting like this. Nobody told me about grants. So that's one thing I want to leave behind. The other thing I want to leave behind is, remember that $200,000 house that I just gave you the down payment for? What if you're thinking it's not for me? Or I want to work on my credit, but I'm not ready yet. I'm not ready to focus on that. I've got too much stuff going on. Let's say you kick the can a year, okay? I don't know what prize I'm going to give. I wish I brought prizes, but I want somebody to tell me if the home appreciates at 5.6% a year, since anyone's ever measured appreciation, 5.6%. Let's keep it easy. I like to do math in my head. Let's call it 5. Let's round it down. Let's call it 5, okay? So if the home appreciates at 5% a year and you delay that $200,000 purchase 1 year, how much more is that house going to cost? Somebody shout out the answer. It's going to cost you $210, right? And if I'm the person who kicked the can a year, how much is it going to cost me? 1 year, $210, right? Almost. If I bought that house, it would have been my 10. So now it cost me 20 grand. All I did was wait 1 year. Just had to think about it a little. That was my money. That's how you build wealth. So another thing I wish somebody told me when I was just in the audience at something like this. Did you know we were talking about FHA, but now you can even do it with conventional, between 5 and 3.5% down. Do you guys know you can get 4 units? 4 units. Now you're building generational wealth. Now 3 people are paying your mortgage, and you have to find somebody to do some financial planning with the extra money. Okay? So now you're really banking some money. By the way, you only have to live there a year. You can move, rinse, and repeat, do it again. Now you get 8 units. 8 rent checks. Yeah. So Wintrust Financial Services, I know Lisa wanted me to mention, because there was a couple of people who had some questions about bonds and stocks. We do that. We don't do it at Wintrust Financial Services. We have a wealth department. Again, just like when they bought my mortgage company, Professional Mortgage Partners, they knew that they were going to start a wealth division. They bought William Blair. They figured, why recreate the wheel? It's a Chicago brand. They're doing it well. So that's what they did. They also bought a company called Chicago Exchange. Does anybody know what the 1031 exchange is? 1031 exchange? Randy, share.
Oh, I was kidding.
Oh, okay. 1031 exchange. It's when you exchange real estate that you own as an investment for what they call a like kind. They used to call it a Starker exchange because the attorney who put this process together, the last name was Starker. But a Starker exchange or a 1031 exchange, they're synonymous. This is when you take real estate that you're renting. Let's say you put 3.5% down on those 4 units. Let's say you've had them now 10 years. Those 4 units you paid $250,000 for are worth $600,000 now. And you've done what's called depreciate that property, which means you've used all your IRS deductions to make that property, the cost basis go down, okay? So that puts money in your pocket from the IRS every year. So when you do that, when you go to sell the house, you're gonna get a tax bill if you've paid that mortgage down or off on that $600,000. How do you avoid it? Well, make it zero. You come to me, I introduce you to somebody at 1031 exchange, and you parlay that into another property. Believe it or not, you can even put that into what's called a real estate investment trust, which is like stocks and bonds. So these are the types of things that we do that we can help with. If you have questions on that. So,
Tons of questions on that.
yeah. But these are the types of things that we are able to offer. So I really, again, no PowerPoints for me, just looking to open it up for questions, because I can stand here all day, I promise I can, and talk about a whole bunch of stuff you guys may not want to know about, or we could just focus on you. So what questions do we have?
I want to be clear again that you stated that there are grants that are available to aid and assist in this process. So it's not basically a lot where you have to have that money readily, you still have money in the bank. But there are a lot of other grant money that you can apply for, so that when we go through the mortgage portion of that, you all will then help to apply for those grants? Or
Yeah.
do you have to do that on your own?
No, we'll talk through the steps. That's great. Thank you. So the steps are, first one, you already took it. You already took your first step. You thought about real estate. All right. Step 2, you're already there. You're here. You're listening to folks that do it for a living. I've been doing it 25 years, $2 billion in closed volume, 7,000 families. You're doing step 2. Step 3 is credit. What I will tell you is this, just keeping things specific. If it's a 620 or less, you probably want to seek out someone who professionally does credit for a living. That's it. If it's a 620 or more, we can usually work with it, and I've got a couple of subscription-based services that'll tell me exactly what to do to get the right FICO that we're looking for. Push these buttons, pull that lever. Lots of the tips and tricks that we heard here today. So depending on where you're at, that would be the next step. But let's assume you've got that 620 FICO or greater, and again, I can show you how to get it up from there. We can. Then the next step is pre-approval. So notice I didn't say pre-qualification. A pre-qualification is when I grab a napkin or some toilet paper, yeah, I got some in the other room, and I write on there, Mr. Jones makes $1 million a second, he's got a 9,000 FICO score, and he can buy a $5 million house. And then a pre-approval is when I collect all of the documentation, income, assets, I review credit, I look at credit history, I put all that information into a database, and I send that information via a portal to Fannie Mae and Freddie Mac. You know what they do? They tell me if they're gonna buy the loan from me. I don't make the loan if they don't buy it from me, because we'd be out of business really quick if we use up all our deposits making loans, although we do have that little portfolio we were talking about where we do things like that. So that's what my pre-approval letter says. You won't be confused about it, and part of that process is to make sure that any and all down payment assistance that you might qualify for is offered to you. Oftentimes, you have multiple options, and I'll help guide you through what's best, right? So I can give you 10 grand, and you have to pay it all back when you refinance, and not for nothing, Lisa mentioned it, rates will go down. So when rates go down, you're gonna end up owing that $10,000. How would you like to know rates went down? You can't refinance because that 10 grand I gave you is due and payable for the refinance process. It's not gonna be a good day. You're not gonna recommend me to a friend. But I can give you $6,000. I can give you 6, that's forgiven $50 a month. So it's forgiven over 120 months in 10 years. And then when you pay that off with a refinance transaction, you can do it with my transaction. Or I could do one better. I'd like to give you the $6,500. If I give you the $6,500, the day you get to my closing, you put pen on paper, you sign, you've got a house, and you just got $6,500 for free, no payment back. Couldn't pay me back if you wanted to, and I don't take gratuity. So yeah, that's the process.
So I want you guys to keep in mind that when you're receiving any type of, with anything financial, there's a qualification process, even if it's a grant. One I mentioned was a first-time homes buyer. Just because you are a first-time home buyer doesn't mean you qualify for the grant. So keep that in mind. So what I'm saying is gather the information to best help you in your process and what that looks like for you. Get a professional, whether it be a lender, whether it be a real estate agent. Get someone who can help you through that process, who knows grants. Like he said, we actually assisted in scrubbing the Will County grant so that we could get it right, because there were some things that would have definitely made your process as a consumer very challenging had we not been engaged in trying to scrub that grant and get that grant. That grant is off and on. Right now it's off, not on, but always engage and find out what grants are available. Again, the loans, the FHA, VA, conventional, they all have different things within that loan you must do to attain those loans too, so we can always talk to you about that. FHA, they require their own inspection. Let's say your own, you consumer get your own inspection, but FHA also has an inspection. So there's a lot of information that you're gathering here, but you do need to take the next steps and just make sure you dig even deeper with a professional to make sure you're on the right track.
Lisa, the one thing I want to add for sure, and I know that I didn't, is while many of these grants are for first-time home buyers, and a first-time home buyer, by the way, is somebody who hasn't bought a house in the last 3 years. So I believe you bought one 13 years ago? Yeah, okay. So you're a first-time home buyer. So a first-time home buyer is someone who has not bought a home in the last 3 years, or not owned, I should say, not owned a home. Yeah. So that's about 1/3 of my grants. They're for first-time home buyers. The other 2/3 of my grants are for new and returning home buyers. In fact, I gave my sister a grant. She bought a home in Aurora. It was a non-contingent purchase. She didn't even have to sell the house she had to get the grant to buy the house in Aurora. And she ultimately did, but she didn't have to. So just don't hear first-time, don't tune me out if you're, oh, first-time home buyer. I bought a house, I have a house, or I currently own a house. No, I still have grants for you. Yes? Here's what I'm going to tell you. The easiest answer is no. If your intent is to occupy that home, you're going to sign a note that says you're going to move into that home as your primary residence within 60 days. And if that's your intent, the answer is no. You're going to be able to move forward non-contingent with owner-occupied, not investment terms. Now, I will tell you, when Fannie Mae and Freddie Mac dropped the minimum requirement for multifamily down to 5%, we had a lot of gamers. A lot of gamers. If you ever hear your loans in quality control at a bank, they're not trying to make sure I'm doing a good job. You're in fraud. So we had a lot of gamers. So basically, you know, I had a gentleman who bought a 3-unit. I take it back, 3-unit. He never moved into it 3 years ago. He said he moved into it. He moved into an apartment with his girlfriend, then bought a planned unit, a townhome. And Alsip now came back to me, wants to buy a 4-unit. And I want to give it to him. But his application said he lived there and he never did. And he signed a contract with the government that said he was going to move in within 60 days. It's called a note and mortgage, backed by Fannie Mae. In this case, Ginnie. So, you know, we had to tell him no. I had somebody else looked and felt similar. We had to tell them no. But your situation would be a yes. But there are some people that would try and game the system. I know nobody here would, but it happens. Yeah. What other questions might we have?
So how long would you have to own the original home in order for it not to be considered that way, even if you're not going to move into the second property?
Yeah, it has to make sense. The general is a year, but it also can simply make sense. I'll give you an idea. I had a gentleman, he bought a house. It was a townhome. He had one entrance to the subdivision. He left his house at 5 in the morning to go Coincidentally, he was a snow plower for the highways. And he had to go plow snow so we could all get to work safely. Problem is he couldn't get out of his own complex because they don't plow until 7 in the morning. Well, after about 3 months of that, he had to go. So we got him another owner-occupied. And by the way, I got that loan from another bank that said, no, we're not doing it. It sounds like fraud, smells like fraud. I'm like, we'll do that all day long. It makes perfect sense. So it just has to make sense. Yeah. What other questions? Am I going too long, Lisa?
No, you're good. You're good.
Okay.
I don't know enough about that space. Because I have heard like too many things about how to go from a single family, then go to the investment. You need to use a single family in order to help you to buy the other doors. So where is that process where there's I guess a gray area that it doesn't just work easily? I know nothing works easily, don't get me wrong, but is it a type of loan that you need to have and it can't be a FHA originally and then the next one needs to be conventional? Where is the part that keeps stopping that from happening, that there's so much red tape that ties that up?
Sure. Well, you cannot have 2 FHA loans concurrently. So if you started out, and I know you didn't say this, but if you did start out with an FHA loan, a lot of people do that, then you'd need to go into the next property with a conventional loan, and conversely so. If you started out conventional, you may want to, then go into an FHA. But with conventional now allowing as little as 5% down for 4 units, conventional is often better than FHA anyway, because while the rate might be slightly better on FHA, what they're not telling you is you're going to pay what's called upfront mortgage insurance premium. That upfront mortgage insurance premium is going to be almost 2 points, 1 3/4 points of whatever you're borrowing. They're going to be nice enough to let you finance it for 30 years, but you're paying it. And mortgage insurance never goes away on that loan. The whole life of the loan, it's going to stay there. It doesn't matter how much you pay it down. So these are the things that the folks peddling FHA loans aren't going to tell you, but I'm going to tell you because my first goal is to get you into a conventional loan. If we have to, we don't want to sacrifice home ownership, we'll go to an FHA loan. We'll even go into an alternative lender's loan with really high rates because we don't want to lose that $20,000 in that $200,000 house. We want you building wealth.
Basically, what he's saying now, because conventional allows 3 to 5%, they are now competing with FHA. So if you can go conventional, it would behoove you to do that because there are restrictions with FHA. There's also restrictions with the grants as well that may impede you from going to your next phase of building wealth. Like you can't have another FHA loan concurrently, which he just said. With grants, there might be a time frame you have to stay in the home in order not to pay the grant back. So that's why I say always ask a professional before you take on which type of loan you want or which type of grant to make sure it makes sense for what it is that your future goals are.
Does Wintrust Bank have any programs for people who receive Social Security income? And they have great credit, but they're on a fixed income?
We do. So we do, and inclusive of disability as well. And if it's short-term disability, we'll actually count your past employer as income, even though you're not currently working there, as long as we have a return to work letter. So yes is the answer, and I'll tell you something about Social Security or other things that are not taxed. If you have a good lender, I'm a good lender, by the way. If you have a good lender, they're going to gross that up 25% and use that as the income figure we use for qualifying, because we take gross income and your Social Security wasn't taxed. So to make it fair for you, I need to gross that up. I need to mark it up. If it's $1,000, it's $1,250. Yeah. Yep. So I just wanted to touch on one thing, because as we turn it over to the real estate folks, I want to touch on inventory, okay? I've been doing this since 1999. I'm pretty good at it. I'm top 1%. That's a humble brag, okay? It's not so humble. But I've seen a little bit, and I've never seen this market. Guys, we have 22 days of inventory. Now, I didn't even know what that meant 5 years ago. So if you don't know what that means, I'm going to tell you now. I'm not going to call anybody out because I didn't even know what it meant 5 years ago. Here's what that means. If not one more house were to come to market, and the same propensity of buyers would step out and say, I think I'm ready to buy a house now, they'd be gone in 22 days. There'd be nothing to buy. You'd be looking for tents. So a normal market, 6 months. 6 months of inventory, 5 months of inventory. That's normal. This is not normal. which is just exactly why that $200,000 house is going to be $210,000 next year. That's fourth grade economics. That's supply and demand. That's why we're not going to see 2009 again. Way too much demand, not enough supply. So I would suggest you let us help you get yours. Any other questions? Please.
Okay, question. If you're in the process of possibly moving to another area, but you have two income properties, or in the case with my husband, probably don't want to be bothered with the income property anymore, what is your recommendation? Should you sell the two houses at the same time, or would you recommend selling the houses at different years or whatever?
Yeah, so is this a tax question?
Well,
Or
maybe,
just generally? Just generally. Look, sooner better for everything, right? We all work hard, right? You need to love where you live. I feel like if you're working hard, you get to love where you live. You should anyway. If you go home and you don't love where you live and you're working hard, come see me. Yeah, so I think you sell the two. By the way, they're going to sell pretty quickly in this environment. We just talked through that. And that's the fastest way you're probably going to get to a non-contingent purchaser, not contingent upon selling anything. The other reason that Lisa and I would, not go to FHA first is because as a seller, you're not going to entertain an FHA offer if you have a conventional one right next to it. Hey, the conventional one could even be a few $1,000s less. You're still going to take it.
the houses are paid off, though.
Perfect. In those situations, though,
That's even better.
that's yeah, right. In those situations, if the intent is to sell them, I'm a good guy to know for that 1031 exchange if you like money. If you do not like money, you don't need to know me. But if you like money, I'm going to help you sell those without a tax ramification.
Okay,
So what's let me just ask you, I'm sorry, what's your name?
Robin.
Robin? Okay, Robin, good question. What, in thinking about selling them, what is the goal for if you were to sell them? Or are you just trying to figure out if that's what you want to do?
Well, my husband, I think he's got a little tired of dealing with it. We have a home.
So you have buildings or?
We have two houses, but we have a house that we stay in already.
Okay,
Yeah.
and you have tenants,
Yes,
and that's where the pain comes in at, right? I'm sure, somewhat.
they're pretty decent.
Okay, they're pretty decent. So are you challenged with the upkeep and the maintenance, or tell me more?
Well, my husband's a little tired of dealing with
Just-
all, yeah, he's
Yeah,
right over there, right?
He's ready to retire from ownership.
Yeah, he's retired, but
But he's ready to retire
Yeah,
from
yeah,
ownership.
yeah.
It's okay. So again, he talked about inventory. The biggest thing that he said here to kind of help you, inventory is low. So what that means is that when it's inventory is low and there's more buyers than sellers in the market, right? Then that means it's a seller's market. It's not a buyer's market. So the buyer has a propensity in this market to pay probably more than what the home may be worth, which is not a bad thing because I'm like Dan, I calculate the numbers. I ask my client, well, how long you plan on being there? The appreciation is 5.whatever%. Are you planning on being here for 5 years? This is what that dollar amount is. Okay, we should bid this, right? So I always get the numbers together, and I don't necessarily like overbidding, but if it calls for that and you love the house, I do a calculation before I say to you, give them this for this house, because it's just not fair. You want to get your equity back as soon as you possibly can, right? So I'm with Dan. It is a seller's market. You probably, I know you would get what you want for it, what makes sense for it. I shouldn't say want, because I always go by market numbers. Numbers don't lie, right? So I'll give you market numbers, and we would come to a happy medium as to what that looks like for you. I could be right on target. That's what you guys were thinking. Let's go, right? Or we'd be like, okay, let's talk about it a little bit more. Let's do our research. How did you come to that number? Tell me more about that. Sometimes when you get that number right in that pocket, right, you can bring that high percent of buyers, right, to your home, and you could possibly get more than what you want for that home or property. Okay. But if you price it too high, and the market, consumers are smart. You buyers are smart. These are not, and plus they're going to be coached by a realtor, right? So you have to make sure that you put that house up in if you go too far over, you might be sitting too, because they know. And then if you have to wind up discounting a home right? If it looks like it's on sale at JCPenney, right? Then you discount a home, and what tends to happen is with that discount, they'll ask for another discount. So if I go here at $500,000 for or you go to $500,000, I'm saying, I think you're more probably at $475. But if you elect to go there, but it's really worth $475, and we discount it to $475, they're gonna want even less than that. So it's very important as real estate professionals to really help you price it right in that pocket in which you can get what you want or need out of it, but you also get the buyers coming to the property to make sure you do get that. So, but it is a seller's market. He's absolutely right. So if you want to talk about what that looks like for your future, it doesn't have to be now or later, just we'll be happy to talk to you about that though. But
Why is it a seller's market? right
because of the inventory.
now? Okay,
The inventory kind of makes it that way, right? Because even though the interest rates, everybody cringes about the interest rates, right?
Yeah.
But we have had higher interest rates than 7%.
Yeah.
In the 1980s, the interest rate was at 12%, right? I get home prices were lower, but they matched inflation. You know what I'm saying?
Yeah.
That's what's happening right now. So the thing about interest rates can always change, right? But the home's values are increasing by 5% or better on average every year. So which battle are you gonna fight? Because you can refinance,
Yeah.
but if that house is 5% more, $10,000 more that next year, plus
20.
you have to put that interest rate on top of that, then you probably made a poor decision by waiting. So what happens is that because there's more buyers in the market, because a lot of people are getting, you know why there's more buyers in the market too? Who rents?
A lot of young people.
Who rents? Did your rent stay stable through 2022? It's stable? It's stable? Okay. How did it go up after 2022? It went up, but it only go up. Oh, so they love you. They love. But let me tell you, renting has gone up tremendously, especially after COVID.
Yep.
You might as well buy a property. If you're gonna pay $3,000 a month to rent a home to pay somebody else's mortgage, you need to be looking yourself.
And one thing I'll add to you, Lisa, is in my research, when you do go to buy a house, it's a layer of protection against inflation. Once you buy a house, and Dan will say this, once you locked in at your rate, your mortgage normally won't go up. The only time it'll go up is if the property taxes go up, which means the value of your house is increased. So like the young lady right here, she said one increase in maybe 10 years, that's not traditional. I own quite a few properties, and I went up on my rent quite a few times just because the market is indicated. But one thing that hasn't changed is my mortgage. You know what I mean? So even though rents might go up $250, $300, my mortgage has been the same, $1,100 for the last 8 years. And so you have a layer of protection against inflation. Cost of living goes up, but yours doesn't. The value of your property goes up, which means you have more equity, which means you are making money and saving money at the exact same time. So it's always more advantageous to purchase versus renting. You had a question? Well, I won't say that. So so I have a traditional vehicle on my mortgage. Traditional will probably be the FHA and conventional, meaning that you're locked in for X amount of years and your payment won't fluctuate. But when you get into things like balloon, those are different things. I mean, you might be locked in for X amount of years, and then at that 14th year or the 5th year or the 8th year, now you got to make a payment of $60,000. That's a little bit different vehicle, but you use those for whatever goal you're trying to achieve. And what Lisa was saying also, once you seek out a professional to help you, that's a realtor, we sit down and we do a buyer's consultation. And in that buyer's consultation, we listen to you, see what it is that you hope to achieve, see what you need, see what you want, and based on those things, with our partners and everything, we utilize our partners to put you in the right vehicle. So for Balloon, that may be an investor vehicle, somebody who doesn't intend on staying at the property for 30 years. They may just want to get in, flip it, and then they can make that balloon payment out of the proceeds because they intend on selling before it's due. But for traditional home buying, it's primarily always going to be cheaper than renting, and long term, I mean, if you look at it, even at a simple number, $1,000 a month, over 1 year is $12,000. So if you wait 5 years, that's $60,000 that you're giving to your landlord somewhere else, versus that 60 grand could have been paying down the equity, paying up the equity in your house, paying your house off. So once you get to a point where it's almost like a savings account that can be influenced by what the market is doing. Like when it's a scarce market, meaning there aren't a lot of houses there, it's almost like an auction. Everybody, I have a bottle of water, who wants it the most? I'm starting at $1. Now you got $2. Now you got $4. And that's what's pushing the values up. So when it's scarce, it's going to be hard to get out there. Because it's a lot of buyers and not many properties, so everybody's going to want it. Now you introduce things like emotional. Like, I want this house, so I'm willing to pay $30,000 more than what you're asking for the house. So that's where the competition reeks in there.
Thanks, Randy. I just wanted to say one more thing, and then I'm going to sit down. If you're in the room and you're a renter, if there was no such thing as home appreciation, and there is, with great assurance there is, but if there was not, you would still be paying. If I'm paying $2,000, I'm renting, Lisa's paying $2,000 a month, she's owning, and there's no such thing as home appreciation. Guess what Lisa gets to take off her tax return? She gets paid another way. She gets to tell the IRS, no, don't tax me on that. I didn't make that much money because all this mortgage interest I paid, you need to reduce my income by that mortgage interest, dollar for dollar, penny for penny, and I'll take my tax money back. Now, thank you. And the other thing is the property taxes. The property taxes are tax deductible. The government taxes, our government taxes on us to influence our behavior. One of the behaviors they want to influence is small businesses. They'd like you married, and they'd like you to own a home. That's why you get those tax breaks. So let's take advantage of the tax breaks and not make, landlords like Randy rich. All right, I'm going to sit down and pass the mic to Lisa. Yeah, there you go. Thank you, guys. Yeah.
Go ahead with your question.
Well, my question was, I'm thinking more on the multi-units as a first purchase versus a single family home. What would be your suggestion on that, or any advice? And
Oh, she got mic issues. I'll jump in. So I'll jump in. So I believe that's the best way to do it. Absolutely, first and foremost. And this is why I was going to piggyback off of the gentleman who spoke over here. Real estate is really the biggest vehicle to get wealthy. You know what I mean? Even in the example about inflation and the equity in the house, that's money that you make without doing anything. So if you can come in and you have the opportunity of becoming an investor and not have to put down 20%, not have to put down 15%, meaning you can get into this house for 3% down and let 3 other people pay your mortgage and also provide additional income. I mean, that's making money while you sleep, which is what we all should be striving to do. We can't be the only thing making ourselves money, meaning going to work for it. So if that's what you're looking to do, I would suggest you do it. The process is the same. It actually isn't the same. It's actually a benefit for you, because when you go to purchase a multifamily and you get approved, and Dan will confirm or deny this, but they will take a certain percentage, I think it's down to 70%, of what the potential rents from the other units will be, and that will be added to your purchase, the power that you have to purchase. So small example, if it's a 4-unit, each unit can rent for $1,000. That means the other 3 units that you don't occupy will bring in $3,000. When Dan goes to do your approval, they'll add an extra $2,100 to your approval amount in order to purchase that building. You see what I mean? So it depending on where you buy, I mean, that alone might be enough to cover it. You could work at McDonald's. making $5.15. What's the minimum wage? $6, I don't know. $15 an hour working at McDonald's. You can get in there and go get you I ain't gonna say $700,000 building, but you might be able to qualify for a $500,000 building if the additional rent can support it. You know what I mean? So it's to your benefit always when you're buying a multifamily. My first purchase, it would have been I got a great deal on mine. I was able to represent myself. I got all the closing costs I can get. I bought anyway.
I'm sure you did, Randy. We know you did.
But even then, and that it speaks volumes. And like I say, working with Lisa or something like that, you can get a multifamily under contract. We get the seller to kick in some money. Dan will get the approval going for you. He'll count the extra rent, and you might only need to show that you make on record $500.
And
Oh, go
this
ahead.
is 1 to 4 units too as well. If you go beyond 4 units, then you're looking at commercial,
Yep.
basically, and that's a whole nother beast, and a whole nother set of down payments, whole set of interest rates, that's a whole nother beast. So 1 to 4 units, which is plenty to build wealth.
Yeah.
Let's keep that
You
in
had
mind.
another
So go ahead.
question.
Okay, I'm gonna ask this question
Come on.
for everyone. How long do you, in order to purchase, how long do you have to be on your with
2
your
years.
employer?
Good question. 2.
Yep, 2
If-
years.
Okay, say you started a new job, but you were working prior to that at
Is it the same field?
Yeah, is it the same field?
Can
What?
we make it the same field? Listen, Dan, Dan,
Is
close
it
your
all
ears, Dan.
customer
Close your
service
ears,
or
Dan.
all hospitality or
Yeah.
something? Yeah,
If
as
it's
long
in the
as
same field.
Yeah.
So that's another myth that a lot of people, that's a good question. If you, so most lenders that I have worked with, there's a bridge that you have in terms of employment, moving from one job to the next job. Couple of bridges. One, 10-year time. So usually if it's less than a certain amount of time, usually 6 months, 5.5 months, whatever, and you go to the second job, good. Or if it's a bridge of a like position, if you move from one job to another job that's a like position, so if it's, like he said, hospitality, or if it's emergency services, nursing, anything like, as long as you can bridge it, most lenders would be able to get you approved.
Or even
But it's
like
2
management.
2 years of total employment, though. It has to be consecutive.
It could be even management. So if you were
Yeah.
a manager at a power plant and now you're the manager at ComEd, because they're both management level positions, that will be the bridge to get you across.
And as far as, you guys said money in the bank, so what do you mean in regards to that? What's the amount?
Same
what's the
thing,
number?
3%, 3 to 5% that you have to be able to show. And that's just show it. That don't necessarily, because Dan mentioned that you'll get grants, and you could be potentially getting grants and things of that nature. So the money sometimes is just for show. Meaning you just have to see that you got 3% in the bank. But when you sit down at the closing table and they do their final calculations, there's so many things that go in to offset what you have to bring. That would be the grants that he's referring to, or that would be the Joliet down payment assistance grants. All you may have to do is just show it. Like, I have the money, and not even, I'm sorry, Dan, but it could be a situation where your grandmother has it, and she's going to write a letter to say, I'm going to gift it to her. Now, Granny may have to provide a bank statement, which is okay. Some people don't like providing the bank statements, but which is okay. So even if you don't overtly have all of the money, but you have someone who does and is willing to write a letter to indicate that they'll gift you the money, that you still qualify.
Yeah, 1 to 4 unit is treated a lot, is like a residential loan.
Mm-hmm.
So there's similar qualifications.
Yes, ma'am.
Go ahead, hon.
I was wondering what you all, what your opinion was on the tax sales, like how they do them at the end of the year.
I'll let Randy handle that question. Randy's an investor, you guys, too.
Well, I bought quite a few tax sales. So Will County specifically has an annual tax sale every year. Now, when you get into tax sales, there's 2 different types. One is the actual tax deed, where you go to the auction, or I think now they've converted to a silent auction. But once it's consummated, meaning you paid them out, you get the property. I'm all for those, but the other ones are tax certificates, meaning that if somebody goes delinquent on their taxes and doesn't pay, you purchase the certificate, meaning if the taxes were $3,000, you pay $3,000 plus whatever the fees were, and if that person chooses to redeem those taxes, they pay you the $3,000 and they pay you additional interest as well, and that can go up to 18%. And if they don't pay, this is where it gets tricky. You have to buy them for 3 consecutive years in order to take over the property. And that means if somebody else sneaks in and pay the second year and you don't get it, you're stuck. Or if the homeowner comes in and pays the second year and you don't get it, you're stuck. So I have a tendency, just me, I stay away from the tax certificate sales and only towards the tax deed sales, because once you pay for it, you get the deed and that's it. Yeah. Yes, ma'am. Yep. Yeah. So you, what do you mean? You mean attached to them, right? Mm-hmm. Right. Right. So yeah, and so the way Will County works is, but on the 3rd year, if nobody has bought the tax certificate or the taxes hasn't been paid, Will County takes the property, and those properties are the ones that are offered in auction. And I think you can go down to what's the Cook County building by the hair place on downtown Joliet, the Cessors. The what now?
Assessors.
Is that
It's on
Chicago?
Chicago and, yeah, it's the assessor's office.
Yeah, I think
It's
right
the assessor's
there.
office.
It's the currency exchange right on the other side of the hair
it's the
salon.
assessor's
So every year, and I think they give out these book. They give out the book of all the properties that will be listed. I think they start giving them out like in August. And you can go get a copy. I think it's $15. And every lot in Joliet that is going to be offered for sale is in that book. They break it down, the dimensions, the location, everything. And once it goes up for auction, I think the auction is the day before my birthday. It's like September the 10th every year.
It's actually online too. So if somebody's
Yep.
delinquent in taxes, that is public record.
Yeah.
It don't make it easy to find though.
Yeah.
But it is
Yeah.
online
Yeah.
where you can find this information out.
Yeah.
But you're right, Will County is 3 years, so you have to be
Yeah.
able to, if it's property, you have to be able to acquire or purchase those taxes all 3 years and not let somebody get in on it.
between
'Cause
it,
if
yeah.
you do, then because anybody can do that. You also have to register to also
Yes.
the auction. You have to register to be a part of that. There is a fee for that, and then you're able to bid. But you also have to bring a certain amount of money to be able to bid,
Yep.
and you have to be able to show money to be able to purchase.
Yeah.
Too. So you just can't go to the auction and just think I'm gonna get a $3,000 property or whatever.
Not anymore. That was the first one I ever bought. I went to the. I'm sorry.
That's not
And
gonna
I got
happen.
time. I haven't
That's
said
not-
much
So I
of
hope
anything.
that, hopefully that
Take my
helps to
time.
answer that question.
But what I'm sorry. But so the first auction that I went to before they became the blind auction, it was actually auction style. The building was over there off Stryker by that elementary school, and you go in there and you raise your hand to bid and everything. And I've had success. I bought a property in Lockport for $2,200 on Fairview, and I was able to sell it for like 14 grand a few months later. But it's not like that anymore. And what I suggest is whatever you do your due diligence. Don't just take my word. I'm a professional. I've done it, but I don't want you to come back mad at me because you didn't. But do your research. Talk to the people down at the county, the people hosting the auction. You can call them and get the information from them, and they'll tell you what the process is, how long everything takes, and what it all comes with.
Okay, go ahead.
Yes, ma'am.
Two-part question. So are you saying the deed and certificate sales are within the same type of auction, so just making sure that you know which one you're bidding on? Or are you saying it's different auctions?
Right. So I think there's 13 states out of the United States that do both tax deed and tax certificate. It varies from county. So Will County is one that does both tax deed sale and tax certificate sale. Now, I'm kind of confident that the same company that hosts the tax deed sale does do the certificates as well. But again, at the assessor's office, they can give you all of that information. They'll tell you what company, they'll tell you the cost, they'll tell you everything. Now, Cook County, and I'm not going to get into it real big, but Cook County doesn't do tax deed sales. They just offer a similar version of the certificate, in which you have to buy the back taxes 3 years consecutively, and then that gives you the right to go in front of the judge and like force a foreclosure, saying that the owner now owes you, and because nobody has paid you, you can force the judge to deed the property to you. Those are normally cash sales because the loan, it's a few steps in the loan that's required, meaning there's an appraisal. They have to be able to get into the property. But until you take full deeded ownership, you don't have access to the property. You see what I'm saying? So you can't particularly use a loan. Now, if you get the house and you want to do a refi, cash out refi, or a HELOC, as Jahan mentioned earlier, home equity line, once you have the ownership, same process, you would apply for approval for your loan. They will have an appraisal, and based on that appraisal amount, they'll give you, what is it, 70, 80% of the value as a take-home.
There is, I just wanted to mention, this made me think of it. There are loans, too, that you can purchase a property. If the property needs improvement, there are loans that you can get for that as well. So if you're purchasing a property and the property needs improvement, it's called one of them is 203K loan, and you can get monies in order to improve the property that you will be occupying. Hear what I'm saying? Occupant.
And one thing to know about the 203K loan, it's not cheap.
No.
It's not cheap.
It's not. But it's not the only option. That's just one of them. So if there was a need to buy, if you you had a desire to buy a home and make improvements, there are loans out there for that. That's basically what I was trying to mention. So, we're almost wrapped up here. And before,
everybody knew to
no,
answer your questions.
You're welcome to answer more.
Yes, ma'am. We got quite a few agents that are licensed in other states. I'm licensed in Atlanta.
Georgia, is there license?
The question: do we have any
in other states?
Yeah. Sorry, we'll get up with the mic. I'm sorry. Yeah. So we do have quite a few agents that are licensed in various states, and if not, we got great agent partners. I got some great friends of mine that are licensed in Missouri, Indiana, Tennessee, all over the world. So if we can't serve you, we could definitely find somebody that will be able to provide equivalent service as well.
Okay, so just wanted to say before you go, if when you leave there, we did bring some sandwiches and refreshments in the back by the kitchen. You're more than welcome to help yourself to them. I know some people already left. I hate that I didn't mention it, but we did bring some things for you guys to take with you. So basically, in this book that we gave you, page 4, it is kind of a roadmap of your process of preparing to buy. This is a little guideline that we use for our consultation so that we can make sure we hit on points from beginning to end of the sale. So each one of these points have points within them. So this is not the entire thing, right? It's just basically a roadmap for the conversation when it comes to buying. Then further back in the book, there is, let me see if I can find the page, another roadmap, page 10, which is a selling process also. So it's kind of a roadmap on how to prepare for sale, what the house should look like, what the market analysis, all that good stuff, right? We do use a lot of acronyms, so if I say an acronym, just let me know and I clarify, but CMA is one of the biggest ones we use, which is comparative market analysis. And another thing we didn't touch on when it comes to credit and getting the loan is the qualifiers, right? One of them is called a DTI, which is debt to income, right? So one of the things that the lenders do is just what I said, kind of in that planning process that you do in the beginning, what those numbers look like, do you qualify? The lender is going to do the same thing. He's going to say, what is your income? What's currently going out? And based on measurements that we have on the back end, we determine whether or not you're viable in order to be able to get a loan. Some lenders can go up to what we call DTI 50%. Some go to 43%. There's a front end, there's a back end. There's a lot of numbers that are included in this, and I can't even tell you what all of them are because my brain is jumbled just thinking about them, right? But keep in mind that lender will also evaluate the debt to income, so how much money you have coming out or going out versus how much money you have coming in to be able to pay a mortgage based on your income. The other thing I wanted to talk about real quick, and we're available for questions after this, because next week we'll do real estate a little bit, but next week is going to be basically about planning, basically about planning, estate planning, trust planning. So once you have ownership, what's next, right? So we're going to talk about that, and there's a lawyer that's going to be here, Mario Reed. He's out of Chicago. This is his lane, and he's going to be here answering, giving you information and answering all of your questions. So one of the things, though, I wanted to hit on, is anybody here self-employed? Okay. So what we run into at our agencies, and I don't want to point anybody out, right, but I'm going to use a certain industry. Beauty and barber industry. We get a lot of clients that come in from that industry and they want to purchase, and when they do their taxes, they show no income, zero, because they're trying not to pay taxes, right? You have to show income. A lender has to see income for you to be able to buy. Because if you have zero income, that means you have zero means to buy anything, right? So you have to properly do your taxes, pay taxes, and make sure that you show income if you're self-employed and trying to buy any type of property or an investment property. Go ahead. Oh, absolutely. Go ahead.
Thank you. Couple things. You unboxed a little bit more than you thought you did there with the debt-to-income ratios. Just so that you know, on the debt-to-income ratios, not all banks are created equal. There are, as Lisa mentioned, 43 is a number. So think, what's 43? So if you're making 10 grand a month, 4,300 would be all you could spend on your new house and all your expenses. So there are lenders that will put a line in the sand at 43, because after the last financial crisis, there has been legislation that came out that said, guys like me gave people too much money and I can be sued if I do that if it's over a 43 debt-to-income ratio. So 43 is where you're going to find some of those, I don't want to name any names, let's just say the improper fraction, they'll be at 43. I'll give you just the initials, PNC, they'll be at 43. So yeah, those bigger ones are they're gonna be there. Yeah, so then there's lenders like myself where we'll go all the way up to 55, and there's alternative ways we can look at income as well. If anyone's 59 and a half in the room or greater, we can always start some sort of distribution from retirement funds that I can forward, extrapolate 36 months and use that as income. And then finally, if you're buying investment property, Randy made this point earlier, those other units can be enough. You don't have to necessarily have a 9 to 5. So I just wanted to, add that.
If I can, oh, go ahead. No, you got a question. Okay, so I just want to break down the debt to income. I want to put some numbers to it. I'm a numbers guy. My degree is in statistics. So if you make $48,000 a year, that's $4,000 a month. Going off of, we'll do 50% to keep it normal. So if you make $4,000 a month and he says debt to income, that means they're going to look at what you can spend to live and for your living expenses as half, 50% of the $4,000 a month. So now that's $2,000. Right? So they're going to take out any car notes that you have. The brand new car you got outside, that's $700 a month. That's going to directly impact how much house you can buy. So if you look at that $2,000, take the $700 away, now you got $1,300. Say you got student loans, $200. That brings you down to $1,100. Say you got another 4 credit cards, and they may go off of minimum payments, but say collectively all the minimum payments are $300. Now you went from 11 to 800. You still can get approved, but it's only going to be able to afford a mortgage that's $800, which is why what he said earlier, why we getting away from as a demographic buying houses, is because we're making the bigger purchases in the wrong order.
Correct.
You see what I'm saying? So if you go out and get that new car, you're eating up your house. Versus if you go and even make it a little more clear, when you go to get approved for a car, they really don't care about your debt to income. It's larger. So you could be paying, you could be at 65%. And if your credit is right and you can afford it, it looks like, they're going to approve you for a car. But if you're going the opposite way, the bank is never going to over-approve you. You see what I'm saying? So you buy the house first, get settled with the house. That might mean you might have to drive your grandmother's Crown Vic for a little bit longer. You know what I'm saying? But you can get a house. Right? And then once you get that house, you take you a couple months to get stable, realize that you can afford it and what comes with the maintenance of it and bills and all that stuff. And then you go buy an investment property. Still don't buy the car. You go buy the investment property and you let those proceeds pay for the car. You know, that's how rich people get rich. They spend their money on assets and let the assets fund their lifestyle instead of using our money to fund the lifestyle, because after the money's gone, the lifestyle is gone, right? Well, the credit card is an emergency. The credit card is only used to build credit and emergency purposes. I got one credit card. I think the limit is $400. I don't need it. I just need that open line, and that's what Jahan was saying earlier. I've had a credit card for 10 years. You see what I mean?
So I'm not supposed to use it?
You're not supposed to use it. Absolutely not.
Why y'all didn't tell me that before today?
Well, no, I mean...
Listen, your credit card should not, you should not use your credit cards in order to be able to live.
Yeah, it's for emergency purposes only. And that's where we mess up a lot. Amex give you that $10,000 line, and you at the Gucci store. Next day. Sorry, Pat.
Did he just...
Sorry, Pat. Sorry, Pat. I mean, that's the trick that we fall into. We think that credit line is free money. It's not. That credit line keeps you in a position where you can't build wealth, which is real money. Real money is the wealth. Like I said, go back into the rental example. If you're a tenant for 10 years, it's $120,000. If you can use 120 grand, raise your hand. Y'all don't know how to raise your hand for real, but that's what I'm saying. But that is the difference. And utilizing the credit the wrong way, it prevents you from being able to utilize it the right way, costing you more throughout your life, never allowing you to get in a position of where you got two houses that funds your cost of living and pays your mortgage. Now, if you want to go try to be a beautician and give up your job as a mail clerk or whatever, chase your dream, now you got the financial freedom to do so. And now when you leave, that's why, I watch a lot of YouTube. You ever heard somebody say, well, the economy got bad and, their wife lost their job and they don't care. They could care less. She'll go get another one or she'll be at home. That's because they've set their situation up to where their lifestyle is being funded by assets and not by you. Because if you go down, if you get sick, it's over with. You one financial hardship away from ruin. It could be an accident. It could be somebody in your family going down, and boom, now you out of there. Now you done went from barely making it to give me all your money. No, not like that, but
pay those cards down. Use them only. Get a card. If you have to get a card to build credit, that's fine.
You do.
Buy some socks, pay it off the next day.
Yep.
Like next month.
Yep. It's just a vehicle to build credit.
Right.
It's not
build
free
that wealth
money.
first, and then have the freedom to do whatever you want to do.
So I know where people are hungry and ready to go.
Yeah.
So two quick questions in regards to the credit cards, since we hit that real quick. So if we have the credit cards, should we close them?
No.
Absolutely not.
Okay.
If you have
Okay,
multiple,
just making sure, because some people have the notion that when they have those credit cards, they want to just pay them off. They pay them off, and then they say, well, so I don't have to worry about this debt. They don't have to worry about, like, people they tempt, and they increase your limit. They get it higher, and then you be like,
well, see, part of that is you, not you, the individual. Part of that is the individual. You got to be in this process. No, it's not. No, I mean you as the individual, and part of this process isn't easy. Meaning you have to be disciplined. You have to be diligent in building or repairing your credit. When Dan requests any type of documentation from you, or he gives you a blueprint to get there, you have to be diligent in getting it done. And because you can see the importance. I just talked about how it can change your life. If it was that easy, everybody would be doing it. So yeah, you might get a line, and once your credit increases, you're gonna start to see your mailbox gonna be flooded with, hey, We'll give you $30,000 if you come on that. No,
Don't do it.
no, thank you.
Yeah.
Like she said, when the lady at the Macy's or the Pink or the Victoria, wherever the women shop, you can get 30% off and we give you 50. No, ma'am, I'm buying the house.
Yeah. But
I gotta stay
keep in
focused.
mind too, with your question, keep in mind, they will close cards on you too if you don't use them.
Yeah.
So there's a fine balance when it comes to your credit. It's a setup. It's a
Okay.
setup. So if you do have the credit already and you're not using it, don't buy some penny candy. Buy something, right? Because what happened is, because it happened to me last year, I was devastated. I lost 50 points. I got them back though. I lost 50 points, but I was devastated. 2 cards, they closed them because I didn't use them, right? So I learned that lesson. So even if it's furniture stores too, I don't need furniture every day, but go buy a lamp. You feel what I'm saying? I already did it. I did the deed already. So if you have them already, go buy something. Go buy a picture. Go buy a vase. But whatever it is, buy socks. Still keep the credit card rotating because they will close them on you and you lose points.
Wow.
The one thing that I wanted to share with the folks in the room that are self-employed, if you're self-employed and you're like most people that are self-employed, your tax returns don't reflect your buying power. You're purposefully asking the government, please don't tax me on that. I didn't make it. Fine. What you want to do is you want to pay all of your bills, not just the ones that are applicable to the business. You want to pay all of your bills with a business account. Now, I'm not suggesting you deduct all your bills or tell the IRS you spent something on your business that you didn't. What I am saying is every lender like me who looks at your debt-to-income ratios will say, oh, you've got 12 contiguous months of the car payment and the Amex, and even the student loans are paid through the business. 2 thumbs up, not even counting those. I'm ignoring them. So now that, as Randy said, that $2,000 stays $2,000. It doesn't go to $800. So just something to keep in mind. Oh, and you can show me the draft before you file it, and I'll make sure it works.
Oh, now
This
see.
is my last question. So I just want to be clear on this. So if you buy units, 2, 3, 4 units, when they go through that as far as the lending portion of that, I may not make the amount to pay the full amount of the purchase, but they take into account the units and what we will receive on the rental property as part of your income to pay for the actual mortgage. Is that
75%.
75%?
And the other side of that is they're not going to let you, well, in the FHA world specifically, they will not let you overbuy. They won't let you get over your skis. And they call it a self-sustainability test. Basically, they want to make sure that 75% of the expected rents will cover the mortgage payment. So, and here's the reason why. They don't want you to get hit by a bus. You can't work anymore. Now 3 families are homeless because you can't work anymore. So they want the building to self-sustain.
Anything else? If not, we're gonna wrap up. We will be here next week, though. We will, next month, I'm sorry. I definitely, I don't know what, right. May 19th, Sunday, May 19th, we will be here again, but don't hesitate. If you want to talk to us prior to that, please, my business cards are outside and in the booklet. I'm in the booklet, and Carmen also, our broker manager, is in there too as well. And then Randall has electronic business card, and